Welcome to Business Talk here on Business Tech. And it's time to talk about the economy, stupid. And what do they say about statistics being like bikinis, conspicuous for what they conceal, more than for what they reveal sometimes? And one could argue the same thing about South Africa's recent revenue windfall, which to some will paper over the cracks in South Africa's fiscal position. But really, it's about what it reveals, and that is a country that is still woefully short of where it should be in terms of growth. And in terms of creating sustainable prosperity for the majority of its citizens. Let's welcome our next guest, Sanisha Packirisamy, who's economist at Momentum Investments, just to take a whirlwind tour through the state of the economy. Sanisha, welcome to the show. We've recently had, obviously, the State of the Nation address. We're having this conversation just ahead of the budget, so I can't ask you to look into that crystal ball. Let's stay with the State of the Nation. Are government's job creation measures announced in the SONA sufficient to eradicate unemployment in South Africa, and what more can be done?
I can't really, pinpoint anything that is wrong in terms of government's employment creation programs and say that these don't work. But I think the main challenge in South Africa is that we have to produce it on scale. So if we think about the unemployment challenge that we face as South Africans, it has grown in the last couple of years. I recently looked at the statistics from Statistics South Africa on our employment data, and it shows that in the last decade, the number of unemployed people, as in those people that have actually left the jobs market and are no longer searching for a job, that increased by 70% in the last decade. So we're sitting with close on 7.6 million people that are without a job and have actually stopped looking for a job. They are in the unemployed sector. So I think that is, the scale in which we are dealing with. And it's quite frightening if we think about, COVID-19 and its impact on employment creation in South Africa. It's also been reasonably negative. So since the beginning of 2019, the private sector shed 1.5 million jobs. And if you look in the public sector, they shed about 437,000 jobs. So often, when we get these State of the Nation addresses, they will say, 40,000 jobs have been created with this initiative or 30,000 here. And I look back to the beginning of 2019, and, since then, we've already lost close on 2 million jobs in the public and private sector. So I think, the key here will be looking at how to generate employment on scale and to fix the underlying problems in the economy. And I think here we really have to look at how we can develop more skills in the economy by improving the education system and improving skills training in general. I think we also have to focus our efforts in parts of the economy that are most labor intensive. And often, we have heard the president in the past mentioning areas like tourism or agro-processing. And these are going to be the centers of gravity in terms of job employment prospects coming through. But yes, I think, with these initiatives coming through, some of them have been reasonably successful, like the youth incentive, tax incentive program. We've heard many stories of success here. But as I say, the problem really is generating this job creation on scale to address the enormous unemployment challenge that South Africa faces.
I mean, because you've just mentioned it's almost 2 million jobs that we've seen shed in the public and private sector since 2019. A big chunk of that obviously COVID related, but even before COVID, the South African economy was not in a great place. Then COVID happened and just kind of magnified and exacerbated all the existing challenges. And so there's been this debate currently about whether or not we need to extend social grants. Do we need a basic income grant or a universal basic income? Call it what you will. And most economists say you have to be very careful because we're already a very heavily taxed country. On the other hand, you've got massive unemployment at the expanded rate, I think, of 46%. So from your perspective, what do you see as the benefits and the disadvantages of an extension in social grants? How do you see the tension in the debate playing out?
Well, Michael, I mean, we know, calls on government have really increased in volume over the last couple of months in order to extend the social relief of distress grant. And I think, some of the advantages that come out from a social relief of distress grant is the number of people that are reliant on this money just to feed themselves. So if we look at South Africa from an income decile perspective and breaking it down into the 10 deciles, if you're in the poorest decile, almost 100% of their income actually comes through from some form of social grant. Even when you move into decile number 4, here we find that half of their income comes from some form of social assistance. Now, South Africa by no means is not spending, a small amount on social assistance as we currently stand. In fact, we already spend about 3.3% of GDP on some form of social assistance. This is much higher than countries like Argentina, Mexico, even India, China. So we are already spending quite a lot. I think, looking at the further benefits of this is that obviously if we have people that are well fed, lower levels of poverty, lower levels of inequality, it does obviously, then represent a much healthier potential workforce in South Africa. It also does lower the chance of increased violent protests. And we also saw that coming through in the past year, that when these social grants, were stopped initially, we saw, a rise in social protests. And once that was then reinstituted again, we saw a fall off in the number of protests. So if you look at the municipal IQ data, one would have thought, with the noise around the July 2021 protests, that the overall number of protests increased quite sharply last year, but in fact it didn't. And I think this is also coupled with the fact that government did extend social grants. Of course, there comes a cost to increasing social cohesion, and that is the fiscal cost. So we don't, unfortunately, have room to have some form of permanent grant as things stand. So that means that we have to then form some other type of revenue source that will also be a permanent structure in order to offset this increase in expenditure. We basically have 9.5 million people that came forward for the social relief of distress grant, so there definitely is a need for it. If we look at other countries around the world, we saw the Gini coefficient, which is a measure of inequality globally. This actually picked up for emerging markets by 0.3, so it's measured between 0 and 1. And that picking up to, by an additional 0.3 basically eradicated any gain that we had seen on emerging market inequality alleviation over the last 2 decades. But what the World Bank has said is that with the institution of grants, spending more on health and education, with government spending more on infrastructure, they were actually able to bring inequality down. Now, in South Africa's context, we have done that in terms of the cash transfers, but these have not been conditional on any health or education outcomes. So I would see that as a bit of a disadvantage. There are other methods that we could try, such as expanding the public sector works program that would then also generate a number of jobs. So once, you get your social grant, that immediately goes into spending in the economy, but then it's gone and you're then reliant on the next social grant to come for the monthly payment. Whereas if we are creating jobs through the expanded public works program, this becomes a self-reinforcing growth initiative. And I think that's really where the complication lies.
And that's why it was interesting to listen to the president in his State of the Nation address. I think there was a sense of admitting that we can't make these decisions based on once-off windfalls around mining, for example, leading to an extra 200 billion rand. We really have to understand what those long-term risks are to both for fiscal consolidation and our debt stabilization pathway. And so saying, well, we'll extend the social relief of distress grant for now, but to bake in a permanent basic income grant, we just don't have enough evidence to say that we can afford it. And this is the right way to do it. To your earlier point, there might be better ways that are far more sustainable. When you look at the main risks to South Africa's fiscal consolidation, and that was really started under former Finance Minister Tito Mboweni and now taken over by new Minister Enoch Godongwana, what do you see as the main risks to that fiscal consolidation narrative and our debt stabilization pathway in South Africa?
I think sometimes people ask, what is the problem with running a high level of debt to GDP? And I think a really good way of explaining it is that in South Africa's case, the interest bill is quite large. So for every 1 rand of revenues, 20 cents is paid away in terms of servicing the interest bill. If you look at their total expenditure, more than a tenth of the expenditure goes towards servicing the interest bill. And this is money that is then redirected away from other social and economic priorities. So this is why we really do need to get our debt burden under control. And I think there are three main risks to that debt burden in South Africa's case. The first, as we've been talking about, is the extension or the permanent extension of the social grant system, especially if there is no additional revenue angle that is going to compensate for this additional expenditure in the next years. The second is any unbudgeted increase that comes through for the civil servant wage bill, so above and beyond what they've already incorporated into the budget estimates. Now, we've seen that government has already started to curb the head count. So if you look at the wage bill, it's obviously made up by the number of people working times by the actual wage increment that they're getting. So on the headcount side, I would say that they have been reasonably successful in trying to curb the increase in headcount that's coming through. But on the wage increment side, I think this is really where we are going to see the proof in the pudding in terms of what comes out for the next set of wage negotiations. And then thirdly, it's the state-owned enterprises and, them potentially needing a further form of financial assistance from government, given that many of them are still facing many financial and operational difficulties. We did hear the president announcing that there is a new investment company that they've formed that will then assist them in looking at their stakes within the various state-owned enterprises in South Africa, and will then assist them in making the decision of which state-owned enterprises may potentially need to be consolidated, which they would want to get rid of, which can they actually sell to the private sector, or get some public-private participation happening. So I think that will be, a step in the right direction. But yeah, those are, I would say, the three biggest risks right now that do face fiscal consolidation and debt stabilization in South Africa.
Those are pretty big risks. And it was said when the new finance minister first took over that he had a lot of political capital, whereas his predecessor perhaps didn't have as much political capital. So he's going to have to bring all of that to bear to ensure that that doesn't become a bit of a runaway train, specifically from my perspective on the public sector wage bill. We don't talk a lot about our rating anymore. Ever since it slipped into junk, we almost just take it as a given that that's where we are. What are you expecting from a sovereign rating perspective ahead of this budget? And what do you expect to be Minister Godongwana's main deliverables? And I might even add to that and say, what would your guidance be for Godongwana? We had tips for Trevor. What's your guidance for Godongwana?
So I'll start with your end question there. And I think, the tips for him, I would say, is to really rein in the public sector wage bill, to consider all the options on the table of how to add poverty and reduce inequality in the South African context, particularly given the already high tax burden on South Africans, and how we're going to actually facilitate the payment of an extension in social grants further out. And then thirdly, to really, put their feet in the ground in terms of the state-owned enterprises, making sure that any additional bailouts are done on a conditional basis. And these state-owned enterprises must be held accountable at each step of the way. I think, half of the problem is that they are not monitored as closely as we'd like to see. And if there is a little bit of slippage, it often happens a little bit too late. So I think those would be my main sort of tips on that. Moving back to your question on the ratings, I do think that this windfall that you've alluded to from the commodity prices are likely to help our fiscal and debt picture in the near term. So I do think that's going to stave off any negative rating action for now. But further down the line, I am still quite concerned about growth and the fiscal metrics. So the fiscal metrics for the three reasons we outlined: the civil servant wage bill, the permanent extension of the social grants, especially if it's unfunded, and then any additional forms of state-owned enterprise bailouts. So that's really on the fiscal side. On the growth side, unless we see an acceleration in the implementation of structural reform, the growth rates that we are likely to see from here will leave South Africa on a growth in real GDP per capita even lower than the bottom quartile of the globe's countries. So that means that our performance is going to start slipping even more relative to our peers and even some of the countries that are beneath our peer group. And that for me becomes quite a big challenge in the medium to longer term.
Yeah, it does boil down to growth, so much of this conversation, because if you are growing, then you've got more of the pie to distribute, more to spend in unlocking some of those bottlenecks to growth and on social expenditure, and it becomes a virtuous cycle upwards. It's sad to say, but we've been stuck in this downward spiral, and it's about getting your hand on that stick and pulling out of the downward descent so you don't crash. And hopefully we do see more of that from the finance minister. This also takes place in a global marketplace, a global environment where inflation has obviously been a big issue, but just recently geopolitical unrest has really dominated markets, and there's been the drums of war that have drowned out almost everything else around Russia and Ukraine. It does look like Europe's eastern border is a real flashpoint at the moment. What effect do you see the current Russia-Ukraine conflict having on financial markets and commodity prices?
So I would say that the major impact is really going to come through on the commodity markets. In Russia and Ukraine's world, what is important is oil, gas, and wheat. So if we look at wheat, most of the wheat. So if we look at Russia and Ukraine together, they basically make up about a quarter of the world's wheat exports. So it is quite significant. And most of that wheat actually goes through the Black Sea, which is, on the verge of where the conflict is occurring. So I do think we'll see some upward pressure on global wheat prices coming through on the back of that. If we look at oil prices, in the past, we haven't actually seen Russia cutting off supply to the West, even if there was conflict with the West. And a great example I heard earlier was even during the Cold War, we still had Western Germany funding Russia to build pipelines between the two areas. So even in those times when tensions were really high, there was still a flow of energy going through at that point. I've also looked at some figures, and if you try and take the oil price and look at it and sort of break it down versus the fundamental price and the risk premium that's embedded there, Capital Economics has done some great work on this. They suggest that about $30 per barrel of the current oil price is actually associated with the geopolitical tensions that are playing out globally. So not only the Russia-Ukraine conflict, but also the conflict that we're seeing in Yemen and the attacks on the UAE also embedded in that price. But they're looking at, past precedents. They've also seen instances of where that risk premium almost went to 100%. So that gives us an indication that over a short time frame, we could potentially see the international price of oil spiking to around $140 per barrel. And then lastly, on gas prices, and this is where, gas is a little bit nuanced. So while Russia could reorient their oil exports to other countries, it's very difficult to do that with gas. And we know that 40% of Europe's gas supply comes from Russia. But if they're not able to obviously change, those pipelines, there's not that much in it for Russia to actually cut them off. If gas prices go back up to their previous peak, which is around 160 euros per megawatt hour, then you could potentially add another 1.5% to inflation for the OECD countries. And that's another statistic that was calculated by Capital Economics. Add that to another 2% on OECD inflation coming from that temporary spike in oil prices if they reach the 120 mark over a few months. You also asked around the...
I was going to say, it really is an energy play. Yeah. Sorry, there was a bit of a lag there. Energy play.
As you mentioned, there could potentially be other channels of contagion in terms of trade or in terms of financial markets. I think it will be less so damaging there than what we're seeing playing out in the commodity prices. So if we look in terms of trade, basically 5% of European Union trade is done with Russia. So that's quite small. If we look at a country like Germany, less than 2% of the imports actually come through from Russia. So it's quite small. If we talk about, the implications for the banking sector, also relatively small. Back during 2014, in the period of the annexation of Crimea, of the total assets held by German banks, there was basically 0.5% that belonged to Russian banks. This has actually come off even further to about 0.2%. So overall, I would say, the biggest impact really is going to hit the commodity angle a bit more, much less so for the trade side and much less so for the banking sector.
Fascinating. And if you to look out and say what the biggest risks are to the global economic outlook, and one hopes that this is a temporary geopolitical conflagration. And I mentioned inflation earlier. That had been prior to Ukraine and Russia the big issue in markets. Do you see that as the biggest risk here, that potentially central banks are behind the curve and have to rate far more aggressively than even the most hawkish of commentators are figuring at 5 or 6 hikes by the Fed? What do you see as the biggest risk to the global economic outlook?
I would agree with you in that inflation is still trumping that risk list, even more so than the current geopolitical tensions that are playing out. If you look at where the consensus was for inflation for this year for developed markets about a year ago, they were expecting inflation for this year to average 1.8%. That consensus is now shifted to 4.3%. So there's been a surge in inflation expectations as inflation has continued to surprise the markets to the upside. We've also seen, a similar upward revision coming through from emerging markets, but less pronounced. So I would say that inflation is still, the major sticking point for the global economy. But we also have to look a little bit further out. So I think what's really important for central banks is to assess the potential for second round inflationary impacts. So outside of the generalized food and oil basket, how does that actually feed through in the remaining elements of the consumer price baskets around the world? And, if we look at some of the global supply chain bottlenecks, these seem to be alleviating at the margin. The Baltic Dry Index, which is a shipping index, is now back at levels that we saw in March last year. Another, phenomenon that's also come about in the recent days is that the ships that are carrying the LNG into Europe and other areas of the world, these are now, going for negative rates. So that just talks about the glut of ships that are sitting in American seas. So that's just an example of how the supply side pressures are starting to alleviate, and that should bring inflationary pressures down. If we look at inflation expectations, these are still reasonably well behaved. We are not really seeing a de-anchoring of wage expectations. Again, that's also a good sign that there isn't likely to be a wage price spiral. Then I would also say, another key risk to the global economic trajectory is the fact that we still have very low levels of vaccination in the poorer economies around the world. According to the IMF and the World Bank statistics, they suggest that only 8 out of every 100 are actually vaccinated in your low-income developing economies. And this means that, if we continue on the rate of vaccination that they've been experiencing, less than 30% will be vaccinated by the end of next year. So this does suggest, that there is still that risk of the COVID-19 virus mutating in countries where the level of vaccination is still quite low. And of course, that could bring about associated lockdown restrictions and further negative impact for growth around the world. So I'd say those, are the two sort of biggest risks out there to the global economy, of course, then closely followed by the geopolitical risk factors that are currently playing out.
Wow, more than enough to keep market participants on their toes. And one can see exactly why there has been such volatility in markets at the start of this year. Great to see the South African market performing so well against this backdrop. We've seen the Rand, I think, as the second best emerging market currency, and also our own JSE All Share among the better performing stock markets in the world at the moment. And who would have called that a couple of years ago? Sanisha, thanks for your whistle-stop tour through our budget, our SONA, and some of the big picture issues that are confronting investors in the global economy here on Business Talk. Take care.
Thank you so much.